Good morning, it's Monday the 30th of January and welcome to our regular Monday morning roundup of the coming week's economic highlights. As always, we'll start with a quick rundown of the key economic numbers being issued this week around the world's markets. And then we'll dive into some of the more significant highlights afterwards with our own thoughts and analysis. So, as always, let's get straight to it. So the economic numbers being issued this week start today with an update on the GDP figures in Germany and the Eurozone's consumer confidence numbers. On Tuesday, we'll hear the latest retail sales figures from Germany, the GDP figures in the Eurozone, inflation figures in Germany and GDP over in Canada. And on Wednesday, we'll hear the latest global manufacturing PMIs, inflation in the Eurozone, the manufacturing ISM numbers, and OPEC will give their latest oil output decision. And also, it's a big week for interest rates, which starts on Wednesday with the Fed's monthly announcement. And that's something we'll talk more about later in the video. And it continues on Thursday with both the Bank of England and the European Central Bank's decisions, which again we'll discuss in more detail afterwards. And Friday sees the release of the global services PMIs, and over in the US, the non-farm payroll figures are released, which we'll take a look at towards the end of today's video. And then to wrap up the week's announcement, the ISM service numbers. And the companies that we'll hear trading updates from this week start today with Ryanair. On Tuesday, we'll hear from Exxon, Mobil, Pfizer, GM, Spotify and Snap. And this week is a big week for results from the tech giants, and Meta is the first on Wednesday with the release of their Q4 earnings. We'll give our thoughts on these afterwards. Also on Wednesday, we'll hear results from GSK, Peloton and Vodafone. On Thursday, the tech giants continue with results from Apple, Amazon and Alphabet. And again, we'll discuss these three in more detail in a moment. As well as the oil major Shell, who are due also to release their Q4s on Thursday. Thursday also sees results from Starbucks, Ford and BT Group. And finally on Friday we'll hear from Sanofi and Cigna. Well, this week couldn't get much bigger as far as market moving events go. Not only the Fed, the Bank of England and the European Central Bank announcing their interest rate decisions. But US earnings season ramps up with releases from Amazon, Apple, Alphabet and Meta. Plus, OPEC will also meet to discuss output for the coming month. The Fed is widely expected to slow the pace of rate hikes. The European Central Bank and the Bank of England will likely stick with 50 basis points, although the Bank of England could be a closer call. Meanwhile, OPEC is not expected to adjust output. And investors will of course be watching earnings releases for signs of a deteriorating outlook, which could raise recession fears. So let's take a look at this week's biggest stories in more detail. Facebook parent company Meta are due to report Q4 earnings on Wednesday. And advertising revenue is expected to slow further, contributing to the third straight quarter of slower sales and the fifth consecutive quarter of weaker earnings. There's also a growing expectation that Facebook's daily active users will fall to 1.9 billion at the end of 2022. That's down from 1.98 billion at the end of Q3. The figures are likely to fuel bets that the social media platform has passed its peak. Investors will look for signs that Meta is controlling costs and protecting productivity. 11,000 job cuts have already been announced. And Wednesday also sees the latest rate decision due from the Fed. The market's pricing in a 0.25% rate hike on Wednesday, taking the rate to 4.25% to 4.5%. And this would be a slowdown after the Fed hiked rates by 0.5% in December, after 4 straight hikes of 0.75%, and comes as inflation continues to show signs of cooling from a 9% peak in June to 7% in November. Still, this remains above the Fed's 2% target, given the solid labour market. Markets are viewing March as the possible final hike in this cycle and will be watching for clues from the Fed suggesting that this is still the case. However, the Fed may be keen to point out that rates will likely remain elevated for some time. Well, it's a big day for the markets on Thursday, which start with Q4 results from the oil major Shell. The company is expected to announce another round of impressive results. Analysts expect a 20% year-on-year rise in sales to $102 billion, and adjusted earnings to jump 41% to $9 billion. Free cash flow is set to rise above $9 billion, well over that needed to cover the $5.5 billion in buybacks and dividends. The $4 billion buyback launched last year could be expanded, which could attract criticism and raise questions over why more isn't being invested into renewables. Still, these buyback programs have also helped the share price rise to its highest level in 3.5 years. And the tech giant Apple is due to release Q1s on Thursday, as the stock trades at around a 5-week high, having risen over 13% from the January low. The share price had dropped to its lowest level since May 2021 after Q4. However, the current price is still some 25% down from January 2022. During the fiscal Q4 earnings, Apple gave no specific guidance for revenue, but did say that sales performance would likely decelerate from September's revenue growth of 8%. Wall Street is expecting revenue of $122.4 billion, a 1.3% annual decline, and earnings per share of $1.96, marking a 6.5% year-on-year drop. And Google parent Alphabet are set to report Q4s after the close on Thursday as well. Well, the report comes after Alphabet shares fell to the lowest level since November 2020 after missing forecasts in its core business in Q3. Since then, the share price has partially recovered, and more recently the firm has announced plans to cut 12,000 jobs in its largest round of layoffs as demand normalises following the pandemic boom. Advertising revenue is expected to slow as firms rein in marketing spending. However, cloud services were still seeing strong growth in Q3. Alphabet trades up 11% this year at a 6-week high, but still trades down over 30% compared to January 2022. Q4 revenue expected to increase 2.1% to $63 billion, and Q4 earnings per share expected to drop 23.5% to $1.17. And the online retail giant Amazon also due to report Q4s on Thursday, and they've already warned that revenue growth is expected to stall to its slowest pace on record for the holiday shopping season as the pandemic boom in online shopping continues to, of course, unwind. The cloud computing arm, Amazon Web Services, is also starting to reflect a more conscious consumer, reining in spending amid the uncertain economic outlook and a looming recession. Sector peer Microsoft has warned that the deteriorating outlook will likely continue across 2023, which could mean another challenging year for Amazon. The firm has already announced plans for 18,000 job cuts as cost-cutting becomes, of course, a central focus. Well, interest rate decisions abound this week, and Thursday it's coming from the European Central Bank. Well, the bank is widely expected to lift interest rates by an additional 50 basis points, and this comes after a 50 basis point hike in December and a 75 point hike in November. Well, the move would take the key lending rate to 2.5%. Inflation is cooling, and data suggests that the Eurozone could experience a milder recession than initially expected. Even so, ECB policymakers, including President Christine Lagarde, have been quite vocal in their support for a few more rate hikes over the coming months, keeping, of course, the euro buoyant. And finally on Thursday, the Bank of England is set to raise interest rates again for February. However, there will likely be a division over whether the central bank should hike by 50 basis points or slow the pace to 25 basis points. And this will mark the 10th straight interest rate hike and takes the benchmark rate to 3.25% or 4%, in the most aggressive tightening cycle since the late 90s. Well, the central bank continues its struggle against inflation, which of course remains stubbornly high in double digits. That said, there are growing expectations that the Bank of England is nearing the end of its hiking cycle after Bank of England Governor Andrew Bailey hinted at a 4.5% terminal rate. And finally, at the end of the week, the US will announce their latest non-farm payroll figures. Well, the US Labour report comes after the Federal Reserve interest rates decision this week, where the Fed is expected to slow the pace of those rate hikes. But the labour market has remained resilient in recent months, with 223,000 jobs added in December, ahead of the 200,000 forecast, and unemployment fell to 3.5%. In January, 175,000 jobs are expected to have been added, and unemployment set to tick back up to 3.6%. Average earnings will likely attract attention after rising 4.6% in December, below the 5% forecast, and the November figure was revised lower to 4.8% from 5.1%. Slowing wage growth and softer job creation would then support the Fed's decision to slow those pace of rate hikes. So those were the big stories of the week. Let's wrap up with a quick look at the dividend announcements due out this week. Well, there are no releases due out in the FTSE 100 this week, but in the FTSE 250 we'll hear from Paragon Banking, Merchants Trust, J. Len Environmental Assets Group, Bluefield Solar Income, Edinburgh Investment Trust and IG Group. So there you have it. It's a big week this week for key announcements across the board, each of which could have significant impact on the markets. So if you're an investor in need of a guiding hand, don't forget you can always get in touch with us here at Atlantic Capital Markets to steer you through those choppy waters. We would of course love to hear from you. It's also worth reminding you about our app, which you can download to any of your devices, which will give you free access to our award-winning trading signals. But in the meantime, as always, thanks so much for watching, and don't forget to click on that subscribe button to make sure that you don't miss out on our regular financial updates, with of course our expert market analysis and our opinions. So as always, until next time, from all of us here at Atlantic Capital Markets, have yourself a great week.